Well, thank you very much. I appreciate the introduction. And I really appreciate you guys, first off, inviting me, and secondly, giving some flexibility to the agenda so that I can get on the road and not endanger myself and other motor vehicles. But we're going to talk about venture capital in the tech startup field. I'll give you a little bit of background about me, nothing gory, nothing terrible. But I spend my day looking at new startups entering the market. We advise our clients. Our clients are mostly Global 1000 companies. Probably a lot of the people on the phone work for companies that we advise. We help them with long-term technical road mapping, 3 to 5 years out. We work with a number of universities, including Oxford, Stanford, and Kyoto University, where we get to see a lot of these ideas being kicked around in the lab, so to speak, and then spun out into startups. Of course, a lot of startups actually don't come out of academia anymore. They come out of basically other startups and incumbents that are out there. So there's a virtuous cycle. But the reason I want to dive into this is because my background is in mathematics, physics, computer science, and systems engineering. I'm sure that's common with most of the people here on this call. And if you cast your mind back to when you were going to little geek school, they didn't tell you anything about the finance side of this industry. And maybe that was for good reason, I'm not sure. But when I started getting introduced to the venture side of the IT industry, it really was a eye-opening experience for me that this is what fuels technology. Certainly there's some good code, some good ideas, great patents, intellectual property that gets developed. But to be honest, none of that actually sees the light of day without venture capital. And I know that sounds very narrow-minded. I'll go through some numbers to say that it's not just my opinion, but that's just kind of the way it works nowadays. So with that, I've been knocking around the industry for a few decades. I can tell by the folks on the phone that some of you have too. I'm not saying you look old. I'm saying you look wise and experienced. So that's there's a big distinction. But anyway, you heard earlier that Kai mentioned that venture capital, it goes back quite a ways. One of the earliest examples we have was out in Nantucket for the whalers, who were taking a look at how they could get their ships out there to get whales in such a way that it was profitable for all those involved. The idea there being is sometimes you go out and you don't find any whales. Sometimes you go out, and if you guys have read Moby Dick, you know that sometimes the whale wins. But nonetheless, it's like an all or nothing proposition. So a bunch of whalers got together, they drew up a treaty, this is back in the 1700s. And they basically said, hey, look, we're gonna back your venture, but to cover our risk, what we're gonna do is we're gonna ask that if you bring back 5 barrels of whale oil, one of them comes to us. That's our fee. And the term that's in the contract is we shall retain 1 in 5 barrels that ye carry. Now, I throw that up there not to just sound like I'm really wise on history, but you're going to see this phrase, this exact phrase, come up a little bit later down the line with, as Kai mentioned, transitioning from non-tech to low-tech to high-tech. This phrase is going to come up a number of times. So those whalers, as kerosene and petroleum oil were discovered and whale oil went a little bit out of vogue, they moved just a little ways down the coast to New York and tried to apply this idea of pooling risk together. The New York Stock Exchange, one of the people that they funded was this charlatan called Thomas Edison, who then moved out to a little place called Menlo Park, New Jersey, where he started industrializing the ideation process, and a ton of patents, some of those with his name on them. He even worked on himself. Many of the others he did not. But this kind of started fueling this early tech industry and linking it to venture capital to fund it. Now, a bunch of those folks squirreled their ways over to the left coast and settled around San Francisco. 2 primary people were Arthur Rock, he was a New York investor, and William Shockley. You guys know Shockley. His name's on all sorts of integrated circuits and wonderful, terrific stuff. He formed a company called Fairchild just down the coast, Look at that, Menlo Park, California. What are the odds that the only two towns called Menlo Park in the United States happen to be involved in my story? Why Menlo Park is common on both? I don't know. It's just the thing. I think it's weird, but it's kind of fun. So anyway, we said that Shockley started this company, Fairchild, and 8 of the people that were the founding members of that company left. This did not please Mr. Shockley at all, and he dubbed them the traitorous 8. But I want to point out a bunch of these folks. You guys probably know a lot of this, but when we take a look at where these folks went on to, so Arthur Rock, we mentioned that he was one of the money guys behind this. Not only did he help start Fairchild, but he started a couple little startups. One was called Intel, one was called Apple. Gordon Moore, one of the traitorous 8, he went on to found Intel, and you guys certainly have heard of Moore's Law. This is that Moore. Sheldon Roberts, he founded a company called Amelco, which is now known as Teledyne. Eugene Kleiner founded a venture firm. What? A venture firm? Yeah, he decided that the money side of this was compelling. He started a firm with a couple of other folks. It's now known as Kleiner Perkins Caulfield Byers. But he had a great quote. He said, "The more difficult the decision, the less it matters what you choose." And that's a fascinating concept. It seems very counterintuitive, but certainly in the venture world, when you're looking to make investments in there, a lot of times it doesn't really matter the solution that you're investing in. What matters is the problem that it's trying to solve. Said another way, the old adage about building a better mousetrap is actually a fallacy in the startup world. Building a better mousetrap is certainly one direct approach, but understanding the mouse is maybe a little bit more profitable. And so this was kind of his philosophy. Eugene Kleiner, interesting guy. Robert Noyce also helped found Intel. Victor Gerinch became CEO of Identronics. They were one of the folks that invented the RFID concept back in 1978. Now that company is known as Datalogic. Julius Blank, he was one of the folks that went on to develop non-volatile memory, which, let's face it, we wouldn't be probably doing the jobs that we had if he hadn't have gone to Xicor, founded it, and came up with that. Gene Honey was co-inventor of the integrated circuit, also started Amelco and now Teledyne, and founded Union Carbide Electronics. And Jay Last also was another one of the traitorous 8, went on to found Teledyne. So that was quite a lofty group of people. But the point here is that they were all kind of gravitationally bound to Menlo Park. And so when they went out and started a lot of these companies that were laying down the foundations of the industry we all know and love, they all were kind of right around this area. So hence Stanford and their technical degree programs just blossomed immensely. And as we know it now, the Silicon Valley was formed around that concept. I'm going to take a stop right there. Throw some questions at me. Make sense? Is this how you understand things? Is this how you see it? Is this even interesting?
Yes, very good.
Terrific. I want to make sure that
Mark, it's certainly interesting. When the time is right, I'm going to ask you some questions that pertain to deviations from the patterns of the Silicon Valley-based VCs, the way they think about investments. When the time is right to ask that question.
Perfect. I think that's you're going to see a couple of slides from here. That's going to segue in nicely. Go ahead and hit your Jeopardy button at that time and throw the question out. All right. So we'll talk about how VCs work. As Don just mentioned, there's kind of this template of the way that VCs fund. And this, you'll notice some similarities from the whaling industry way back when up through investments made this morning. Basically, someone comes along and says, I'm going to create a bucket and I want a bunch of people to put money in that bucket. Now you have to be very charismatic and influential to convince people to put money in a bucket, but nonetheless, there are some people who are very successful at that, and they get limited partners like the state of California pension fund or the endowment for the Rockefeller family or even private investors. They go ahead and put their money into a bucket. Out of that bucket, this venture firm goes out, researches, finds startups that are in line with what their thesis was for that fund. So their fund may see we're going to invest in early stage US-based small cap technology companies. So when they find one of those that meets their criteria, they go ahead and invest, and they take a 5% management fee. That's how the VCs pay for the light bills. Once that startup exits, and I'm going to use the positive example first. By exit, we mean they're acquired by a company or they IPO. Of course, the negative exit is they go bankrupt and they are no more and no one ever knows their name. When that company has a successful exit, our little statement comes back. We shall retain 1 in 5 barrels that ye carry. So 20% of the profits, so above the amount invested, goes to the VCs. That is still true today, and it still is 20%. There's a few little exceptions to the rule out there, but for the most part, 20% is the carry. So that's basically how the venture world works. And that 20%, of course, helps fuel things, helps go into other funds. But even after that 20% is paid out, you can imagine that the California pension fund, if everything goes right, receives a nice return on their investment. Now, the way that the startups work with the VCs, we kind of talked that there's this exchange of money, but there's an exchange of a lot of other things. So a startup will come in, make a pitch to a venture. By the way, some of the top tier venture firms get tens of thousands of abstracts per year for startups, from which they'll go ahead and look at pitches from hundreds or thousands. So you can kind of imagine that big funnel at the top kind of narrowing in. For the ones that they like, they'll make an offer. If that startup accepts it, and you can imagine there's negotiation that goes along there, then there's a signing of what's called a term sheet. That investment happens, money and equity exchange hands. But here's the crucial thing. At that point, the venture firm will provide guidance to Acme Corporation. Typically, they'll put someone on the board. They may link them up. Let's say Acme is making anvils. They will hook them up with the Union of Coyotes in Arizona and get some actual real-world feedback into this startup. That guidance takes a number of different forms. We'll dive into that in a second. And if everything goes right, Acme exits, a bunch of money goes back to the venture firm. They go ahead and get some carry, and 80% of the money goes back to the LPs that put money into the fund. So that's kind of the back and forth of it. But this is the part that you don't hear a lot about. And this will link in nicely with what Don had posited earlier. There are a number of different investment models that have recently come up. One of them is crowdsourcing, so things like Kickstarter, for instance, and other ones are SPACs, as an example. That's a popular one about a year ago, where you have a fund that IPOs itself and then goes and makes investment. The big difference between venture funding and SPACs and Kickstarter type investments is there is none of that guidance step. The typical venture firms, and I'm talking mostly about top tiers. If everyone on this phone decided to start our own venture fund, we could do that, but we probably wouldn't be able to offer the services that, say, a Sequoia or a Kleiner Perkins that we mentioned earlier, or an Andreessen Horowitz or a Greylock. Those are some of the biggest venture firms out there. When they bring a startup in, they will help them set up payroll, get facilities, get legal to incorporate the company, and make sure that their license agreements are all in check. The venture firms, they are very good at this. As they say, if you're a startup company, you take care of the startup, we'll take care of the company. And so they may also go to their Rolodex and provide the first head of sales. Typically, startups are by engineers or angel investors that have a terrific idea. They believe they understand the mouse better than anyone out there, and they've got the best cheese in the world. It turns out that a lot of times they don't have a lot of sales acumen, or maybe they don't have a lot of marketing background. So the venture firms can help provide that. They can also connect that startup with industry thought leaders and with their first potential customers. So that guidance is a very, very valuable thing. And that is one of the big differentiators right now out between, like I say, between, say, a SPAC and Kickstarter. Have I addressed your question, Don? Have I hit that?
No, yeah, you have, Mark, and you've explained the landscape pretty well. It makes sense to me, and it's consistent with my personal experience. Again, I'm going to hold my question until you've explained where you're coming from a little bit further. But let me just throw out a hypothesis there. I mean,
Mhm,
so I'm running a startup company now, and I won't go any further into my background. But
mhm,
when I uh, when I and my associates approach the Silicon Valley-based VCs, they're operating on timescales much shorter than the timescales required for returns on investment if you're addressing the industrial market. It seems like Silicon Valley is based largely on consumer types of products and revenue, and when you approach them with a customer model that has sales cycles that are measured in year or years, not weeks and months, they just turn off completely. And
mhm,
so for those of us who are trying to grow companies who need capital, um, I think we need an alternative model to the Sandhill Road guys. And
mhm.
I'll just leave it there. I'll just leave it there.
Well, let me dive into that right now, just because my primary goal on this isn't to get through my slides. It's to actually have a conversation and dialogue with you folks, because I learn a ton by doing this. So Don, by the way, kudos and 3 brownie points for mentioning Sandhill Road. That for those of you that aren't familiar with the venture community, the bulk of the top tier firms are on a little stretch of real estate that's adjacent to the particle accelerator at Stanford on a little street called Sandhill Road. And believe it or not, the property values there are higher than in Manhattan, if you can believe that. So, but you raise a very good point. 20% of top tier investment is to the enterprise side. 80% of that goes to the consumer side. I myself focus solely on the enterprise side as opposed to the consumer side. On the consumer side, what you mentioned is exactly true. Very fast cycles. You want to early money in, early money out, and that's how they return the profit to their the investors in their funds. There are, however, a number of different types of investors out there. We work with 2 firms that are what we call micro investors, and they are very long burn investors. They don't make a lot of investments, hence the term micro, and they have a very narrow thesis. So we're working with one that only invests in quantum technologies. You can imagine for let's say quantum key distribution, or even quantum computing, or quantum circuits, quantum simulation, those are many years out before you'll see a return. So a lot of times, if you go to some of the big names on Sandhill, it's not exactly an impedance match for the business that they're looking to do, but there are more and more of these stratified investors that are looking more at the long term. Now, one of the biggest problems is, how I mentioned earlier, tens of thousands of abstracts that come in. How do you separate yourself out of that pack to where they'll actually take a serious look at what your particular problem is? And if I could tell you the answer to that particular problem, I'd probably be sitting at my own startup right now. But that is something that is quite difficult to achieve. I hope that speaks a bit to where you were asking.
Yeah, absolutely, Mark. Thank you.
Perfect. Okay. So again, back to kind of the how of the problem. So we've got our Acme. We have a little seed funding. That's family and friends, second mortgages. At some point, maybe we decide, I'll use Dawn as an example. Hey, we'd like to go out and get an A run. We'd like to give up some part equity in our company to pull in a little bit of cash, maybe to help us finish prototyping, get that product market ready, or at least a minimal viable product ready out there. Okay, that went really well. Let's get a B round. Let's bring in, maybe it's the same investor, maybe it's a different investor, to help us actually start getting our first office space. We're going to start bringing on testers and documentation and trainers and go to market and our first sales folks. C round and D round are really where the companies start to form themselves, kind of like when you've got a baby and they learn how to talk. That's when you can actually start seeing what's going on inside their heads. So C round and D round, notice, could be multiple investors, could be different than the ones that did the A and B round. Sometimes those C and D round investors buy out the A and B rounds, hence that quick money in, quick money out term that I mentioned earlier. And who knows, they might go to an E round. That's what we call a growth round. The group that I work with, we don't pay much attention to that DE type of maturity. We try to catch them more in that seed ABC in that phase. That's when we try to make sure that they're hitting our radar. But eventually, let's say they get an exit. So you can kind of see from this, if you're in at the A round, maybe that's 30 times the return that you put in. If you put in the E round, you might get 40% back. Well, let's face it, 40% is still a pretty good return on investment. But you can see that that's a very different game that A round investors have than an E round investor. But the one thing that we are seeing is starting back in the 80s, some companies said, look, when we're going through that prototyping and development phase, I don't want everyone out there knowing what we're doing. If we've truly discovered the better mouse, and a flaw in that mouse's behavior, I don't want the other mousetrap builders out there to go ahead and build mousetraps based on our knowledge. That stealth phase right now is extending longer and longer. We've seen from 2019 through today that stealth phase for, and I'm talking typical average type numbers, has doubled. So a lot of companies don't see the light of day until they're kind of in their C round. And there's another phenomena going on, which I kind of don't want to get into, but let's just say markets are down right now. So some companies aren't calling their B round a B round, they're calling it an A2 because the valuation is lower. And if you get a down round, that's the kiss of death in the startup world. So they're now renaming B rounds A2. They're not fooling anyone. But anyway, that's a weird thing that's kind of going on right now in the market. But one nice thing is to get a peek behind that stealth barrier and catch those companies in that seed A, B round type phase. But that's the group that I work with, that's our intent. And so the venture firms we work with, we get kind of that peek behind the curtain. If you do everything right, your growth is through the roof. You can imagine that there's a very high child mortality rate in this industry. Every venture firm guards that number, as if it was the crown jewels. But our empirical evidence suggests that about 80% of startups don't return the investment that was put into them. Only about 5% return double the investment put into them. And then, of course, there is the 1% that returns multiple and multiples of that. If we take a look at where this funding comes from, globally, the United States, this is coming up on a year old. So certainly China and India have increased a little bit, but still the United States does more tech venture capital than the rest of the world combined. But that is changing. There'll come a point where China is going to be right there shoulder to shoulder with us. If we take a look at where that is, if you take San Jose and San Francisco and add them together, there is as much venture capital being invested in the Bay Area as the rest of the country combined. Look at that, Austin, bright lights, big city. They're right up there. Austin is one of the top 6 venture locations. So you guys are well situated to be right at the hub of that. If we take a look at the investment, it has grown substantially since, let's call it the post-mortgage era. And last year just broke all the records out there. This year is down a bit. I don't have statistics, obviously, for this year. We're not done quite yet, but look for that to dip down. It seems to be a formula that is only growing. You've probably heard about unicorns, those companies with a valuation of greater than $1 billion. And you can see that the number of those is increasing. And up through February this year, we cracked 1,000 unicorns in existence at the same time. That's never been done. And that happened earlier this year. The unicorn count has since dipped. I mentioned about valuations dropping. Maybe I should explain valuations real quick. So if I take a look at your company, I come up with some number. I think your company is worth 10 million bucks. And you tell me you're crazy, it's worth 100 million. And we go back and do some voodoo science and come up and we agree, nope, it's worth $20 million. That's the valuation. That's what I'm going to buy your equity at. That becomes your valuation. If that valuation ever goes down, that kind of says you're circling the drain in the sink. And so that's kind of been the kiss of death. Last year, you saw that venture investment was through the roof. So a lot of those valuations got inflated. They were really, really high. And so now the markets have dipped down. So if you got a valuation last year of, say, our 20 million, and you're trying to get a B round right now, that might only be 10 million. Again, that's more because the markets are down rather than your product doesn't work. So people are trying to come up with creative names for it. But suffice it to say, there's some very large startups out there. In February, there was a unicorn being created about every 26 hours. So that's a heck of a hit rate. I will tell you that is not where we're sitting right now. But at the height of things, that's where they were. Most startups on average are most unicorn startups are on average 7 years old when they attain unicorn status. 50% of the unicorns in the world are funded by only 20 VC firms. Depending on how you count it, in enterprise IT, there are about 2,000 to 3,000 venture firms out there. 20 of them do half of all the unicorns. Hence why we try to do business with those 20. It cuts our failure rate down substantially. And of the companies that get venture funding, only 2.5% reach that unicorn status. Again, I think if I was to do this after this year completes, that unicorn rate is going to drop significantly. Any numbers here shock you guys? Is any of this surprising at all? All right. I'm going to go through this is kind of a controversial topic. I mentioned earlier that our clients are mostly from the Global 1000. And this is the ugly baby story that I have to tell most of our clients. And that is, if you work for a large incumbent company, and I can give you the definition of large and incumbent, you're over 8 years old, you're over an $8 billion valuation, you have IPO'd or have taken substantial private equity funding. If you're one of those big companies, and there's some giants that, I don't want to mention them because you guys probably work at a bunch. It turns out that it's almost impossible for them to actually innovate new products. They do a terrific job of doing R&D, of enhancing and incrementally increasing the products they already have. But as Clayton Christensen pointed out in The Innovator's Dilemma, it's almost impossible for large incumbent successful companies to innovate. Now, a lot of our clients fit into that category, which is why they call us up and we work with them. But a lot of times they will say, oh no, we've got, one of our clients has, I wish I was making this up, has a $10 billion R&D budget, out of which they produce very few products that go to market. The main reason for that is incremental innovation seems to be what the focus of most R&D is. But the other thing is the creativity, the risk-taking that great founders like Don have don't get they don't get rewarded or incubated very well in large corporations, regardless of the marketing hype. And so for many companies, it's much cheaper to go out and buy a startup than it is to actually create it yourself. Now, the evidence I want to give you guys for this is if you take a look at a large technology company and take a look at the products they sell, they're going to fit into two buckets primarily. They're going to fit into that product that made them famous, their original mousetrap. And now we're on mousetrap 9.3 with some amazing, amazing stuff that's been chunked into it. Maybe some artificial intelligence. Who knows? You lift up the hood and there's blockchain going on there. So great and terrific stuff. That's one bucket of products that'll be be for sale. The other bucket are going to be companies that were bought through acquisition. Some really hot slicer and dicer startup that was bought and added into the integrated into the product offering. It's very rare. It does happen. One example would be Amazon introducing Amazon Web Services. That was certainly different than what they were originally known for, and certainly a very successful startup. So there are exceptions, and certainly Google and Amazon are two of the few very large companies that are able to innovate. I know you guys are thinking, why didn't he say Apple? And yeah, we could, depending on your point of view, we can argue about Apple and the technologies they're bringing to market. Certainly, these are very successful companies. I'm not saying that they're dumb or ineffectual. It's just that disruptive innovation probably won't come from them. So the more typical story is out of those tens of thousands of startups. If we take a look at the thousands that break even, the vast majority of them have VC funding. And of the unicorns that are formed over the past 5 years, 100% of them have been VC funded. Again, unicorn being that billion-dollar valuation. Now, what typically happens in outovation as opposed to innovation is one of these large incumbents will go and buy one of these unicorns. I'll give you an example that I know quite well. Cisco bought AppDynamics several years ago. Oracle, if you guys remember BEA from back in the day with WebLogic, that they were bought for $3.8 billion. And there are literally thousands of these acquisitions being done every year. Something that is a little bit new, we are seeing some of these startups buy the incumbents. And I know that sounds oxymoronic, but there are times where little fish out there, especially new startups, have a valuation higher than some of the leading tech companies out there. So we are seeing that. That doesn't happen often, but it does happen to where it's just cheaper to actually buy the incumbent than to beat them in the marketplace. We mentioned earlier about those 10 components. This is where that guidance from the venture firm becomes critical, because once we get up to that unicorn status and we start talking about merger and acquisition, let's say we're Jody Bonsall at AppDynamics, and we've been running that for a number of years, and now Cisco is making an offer. Is that a good offer? A bad offer? Should we wait another year? Maybe the market's at a peak and I should grab it and run. Maybe we're just now getting started and we should wait another year. It is critical to have that venture firm that has been through this. Keep in mind, they've got money in that company too. They want to maximize their gains, same as everyone else. So this is where a lot of that guidance becomes critical, is on that acquisition side. Okay, I'm going to stop right there. Dawn had some questions that had been queued up. We can tackle those. And if you guys have got any other questions, please don't hesitate. Fire away.
Well, Mark, just to break the silence, I can certainly validate your comments about the difficulties of big companies innovating. There's just so many, constraints. There's so many things that just, cause regress to the mean. When you have multiple layers of decision making and everybody supplies a safety factor on it, it becomes, nobody takes a chance on anything at the end of the day. So I can certainly validate your points there.
Perfect.
So this is Pat. I actually posted a question in the chat. I don't know if you saw it.
My apologies. Let me open that up.
Yes.
Sorry.
About control.
Yeah, no, well, this is the $64 billion question. If you want to retain control, picking the right VC, and by the way, that's a luxury to have, where you get to pick the VC. Having that is the key to it. I'm going to tell you about one VC out there, and this is Sutter Hill. Not Sutter Home, the makers of box wine, but Sutter Hill. They're one of the most successful venture firms out there. They invested in companies like Pure Storage and Snowflake. One of their terms that they have, if they invest in your company, regardless of almost who you are, unless unless you're Steve Jobs or something like that, one of their conditions is they replace your CEO. That's part of their formula. So you can imagine right off the bat, if you get an investment for Sutter Hill, control from a not just a financial point of view, but from an executive point of view is pretty much gone. But that's what you're signing on for, and their hit rate is crazy. The number of companies that fail coming out of Sutter Hill is very, very small. And so that's the trade-off that you make. On the other extreme, when you go to a micro venture firm that we were talking about earlier, you're able to retain a lot of control from that. Now, a lot of times you're going to have some street cred. Maybe starting up a startup before is in your background. That's terrific. Or let's say you're doing a startup in the healthcare market. You being a CIO at a large healthcare company, that bodes well. So that I really think is the key to maintaining control of your company when you get that in. But the biggest thing is probably in that picking the VC, and of course when you're negotiating with the VC, if you're the hot kid on the block. I'll mention a company, by the way. Transmit Security is one that we really enjoyed watching last year. Let me give you a little bit about them. The average kind of the textbook for A round funding has been 3.8. That's the average. It has been for a long time. That spike we saw over the past 2 years flipped those numbers, and the average A round went to 8.3. Transmit Security came along, and before they got A round funding, they already had a several $100 million run rate of customers. Their first round of funding was $523 million. So an A round, that's insane. That number just goes off the charts. You can bet those folks maintained a ton of control. The equity slice that they wound up selling for that $500 million was proportionally very small. But you have to be the belle of the ball to be able to do that. Most companies that are out there, unfortunately, and I wish this wasn't the case, as an engineer myself, most startups out there are founded by a couple of engineers and a great idea. When you go into the venture negotiations, let's say for an A round, keep in mind that venture firm is there to maximize returns. They want you to be successful and so forth, but it isn't necessarily to help you buy a yacht. So when you get into negotiations, that's when the street savvy. I would almost recommend, if you're in negotiating that valuation and the equity slice, that you bring in someone that has experience doing that. By the way, I'm not making a commercial plug for myself. That's not my neck of the woods, but there are people out there that are very good at that. So unless you're the belle of the ball, when it comes time for that negotiation, you really need to pick a VC that's going to do the best by you. We got another question here. It says, let me just read this out. When an existing small firm wants to scale up, what do VCs look for when deciding to invest? So typically C round is your scaling round. That's when the VCs are looking at what's your go-to-market and sales strategy. So at that point, it starts transitioning from the focus being on the product being developed into the acquisition of customers, reference accounts, big names, revenue. That's when that typically is in that C round. So if I'm a C round venture firm looking at your company, I'm going to want to see that ability to go to market, or the opposite. I'm going to need to see you wave the white flag and say, look, we're a bunch of engineers. We really don't know a lot about it. If you come in as a C round investor, we would love you to help us get a new head of sales and to set up a channel reseller model, as an example. Well, okay, that's a company that I might invest in because they know they're not good at it. So you're either in that C round time, you're either really good at sales and can prove it, or you admit that may be a weakness and you would like some guidance from the venture firm, and you're willing to give up some equity to get some cash and some connections to pull that off. Does that answer the question about scaling up?
Yeah, well, one part of that, imagine you have a small firm that had never been externally funded. They never had an A round. So if you're looking to scale up and looking for a VC, does that, what would they look for in that case?
Yeah, what they're going to want to look for if you're coming in with no positions, no investment positions in the company, the things that they're going to look at is when they go to scale, do you think you can pull it off and all you lack is money? In which case you're not necessarily looking for those 10 steps of guidance. If that's rare, by the way, but it does happen. Or do you realize that when you go to scale, it's going to require a lot of dance moves that you can't make? And if you're looking for us for guidance, us, by the way, meaning the venture firm, and you want us to come in with our 10 commandments of guidance, and you're willing to relinquish that control, okay, I think we've got something to talk about. I hope that scratches the itch.
Yep.
Got it.
Also wanted to ask how small firms find VCs.
This is I wish I could tell you a really a trite answer on this, but the best analogy I've been able to see is it's the same way as Hollywood, right? How do you become an actor in Hollywood, right? And it probably involves waiting tables, or it involves your uncle being a director at Paramount, right? And that is actually the case in the startup world. You either you grind, you have a great product, you do get a chance to make a pitch, you really make a terrific pitch. By the way, pitches are the make or break. Think of that from a Hollywood point of view. That's your audition. You blow your audition, they're not going to say, yeah, but they were so nice. No, it's like, next. Don't call us, we'll call you, right? There is that. Nepotism runs rife. The easiest way to get funding for a startup is to have previously sold a successful startup. So serial entrepreneurship, they certainly get first dibs on things. I talked to a venture firm one time. They said, hey, we got 3 guys in the next room. I want you to go talk with them. And I asked, well, what are they making? And his answer was, I don't know, but I'm investing in them. Because this is I've done that twice before and did very well. So I don't know or care what they're building, but I'm in. So there's such a skew that way. Now, having said all of that, it's not impossible for people who don't have, let's say, a degree from the AI lab at Stanford, or who haven't done a startup, or who haven't worked in the venture world. It still is possible. In fact, I would say probably most of the startups out there fall into that category. But I'm just going to warn you, the competition is very steep, and it's getting steeper. It used to be back in the day, let's say if you wanted to have a software product and get venture funding for it, you would have to go out and buy, I don't know, maybe I'm dating myself, but like a Spark station and some really clever software, and hire a bunch of coders, and you sit down and you code it all up and you run it through some rudimentary testing. And now we need to make a staging environment that's like our customer's production environment. Boom, we need some more funding to go buy Spark stations. Nowadays, you can swipe a credit card to AWS, and your product now with a very, I'm talking dozens of dollars, can have built-in AI models, a nice GUI on it. And by the way, if you want your GUI to be all customized, you can go to Fiverr and get GUI designers for several $100s. So coming up with a software product is, like I say, I don't want to say it's turnkey, but it's very straightforward, and the barrier to entry in this market has dropped significantly over the last couple of years. I'll say since the advent of public cloud. And so everyone, their sheepdog, can make a startup nowadays. So differentiating yourself from that is the hard part. And I will say the companies that we see that get the funding and then customer traction within the accounts we manage, the one common denominator they have is what I mentioned earlier. They're not too worried about the mousetrap. What they're worried about is examining and understanding the mouse a little bit different than the other companies that are out there. Having that different approach and the ability to articulate it, this ticks me off as an engineer, but the truth is the truth. Building the solution is trivial. And I don't like that. I prided myself in being one hell of a software engineer back in the day, and I could code circles around the next person over there. Guess what? It doesn't matter. Today, it doesn't matter. Because I can get a convolutional neural network and a MapReduce data store, and the ability to scale up to tens of thousands of installs, literally with a swipe of a card and a couple key clicks. So that's just the reality of today. Okay. There's another question. What kinds of returns do VCs typically expect, and how soon do they expect to wait until they return control back to the firm? As I mentioned, 80% don't return their investment. So, a venture firm invested $1 million and it turned into zero. That happens 80% of the time. 20% of the time they get back their money, and it might be, percentage points of return. There are some companies out there. Sequoia invested in a little company called WhatsApp a few years ago. They invested $300,000, and when it exited, when it was sold to Facebook, who coincidentally is another Sequoia startup, for $19.8 billion. So someone can do the numerator denominator trick on that and figure out what the return on that, but it's better than I get at my savings account. I can guarantee you that. Other ones that I've been involved in, I think, the best that I've personally seen from going from 2 guys in a PowerPoint to exit was 28x. So for every dollars the venture firms put in, they got $28 out. There's one going through negotiation right now, I won't mention. It's looking to return 63. So you can kind of do the power series mathematics on this and say that it's actually those 1 or 2 unicorns that hit that is paying not just all the 80%, it's also paying the 5% management fee, the 20% carry, and the return back to the limited partners. So that's how the game goes. And there are firms out there, by the way, that have a strategy that's a little contrarian. They want to, I'll use a baseball metaphor, never trust a technician that uses sports metaphors, but I'll use a baseball metaphor. Instead of swinging for the fence on every pitch, they're looking to get double singles. And if they can get a walk on, that's even better too. So there are venture firms that's more their strategy. Sutter Hill that I mentioned earlier, they're a swing for the fences, so much so that they're going to put the CEO in place. So these venture firms have very different strategies on how they go about it. And the second part of that question is kind of interesting, and that says until they return control back to the firm. Once you're in the venture world, I wish I could say it was different, but there never is return of control. Because the exit is you're going to get bought by, say, a Cisco. Well, now you just have Cisco to be beholden to. The venture firm, they take their share of the equity, and then they go off and they're going to invest in other companies with that, let's say. The other alternative is if you get IPO'd. Well, now you trade in your one venture firm. Now you've traded that for the SEC and 10,000 hungry investors. So once the control is gone, it's gone. And it tends to continue to diminish after that. That is just the way of the world. But you're one of the ideas. If I can just retain, I'll make up a number, 10% of a company, and that my company happens to be called Oracle. Hey, that's a pretty healthy 10%. So that ain't too bad. I don't have car payments. I'll put it that way. So, all right. Any other questions?
I have one more, and I know you're short on time. I don't want to monopolize everything, but can you do one more? Okay.
Yeah, let's do it.
So my last one, are there matchmakers out there that a small firm can go to and say, here's kind of what we're looking for in a VC arrangement, and they know who to go to, or vice versa, a VC that says, we're really interested in this space?
I will. To answer your question directly, yes, there are matchmakers out there. They are completely ineffectual. That's my experience. What there are, though, that I do think is interesting is there are startup coaches that will take a look at your pitch and say, dude, you have 3 slides telling about your background. You're not Steve Jobs. Nobody cares. Let's focus again on the problem that you're trying to solve. If you had 3 slides on the problem, this would be a total different pitch. This is terrific, right? There are also professional pitchers that will go out and pitch. that are comfortable in front of audiences, that are able to have a subject matter expert, typically the founder, sitting beside them and hand off questions, when they get teed up. There are people that do that. I think that those people can change the odds a bit more into your favor. But I do want to point out, as a startup, you typically don't have anything to offer these people other than equity. So if they believe in yours and they're saying, hey, I'll work with you to hone your pitch, a lot of them will say, I've got an uncle that works at XYZ out of Charlotte, North Carolina. Yeah, the odds of that, use the Hollywood metaphor. I got an uncle that makes short films out of Charlotte, North Carolina. I think I can pitch your screenplay to him. It's like, really? You think that's what's going to work? I don't know. But that's my biased opinion. I have no data to back that up. Certainly knowing people, that certainly helps. By the way, I personally and my organization, we have a policy that we never do matchmaking, that we never do an introduction. Our venture firms that we work with are not in short supply of startups. Once in a while, if we have a startup that is already funded by another firm and we really see it taking off in the market and gaining traction, we will mention that. But typically we don't advertise, if you will. We don't go out there and hawk startups, but there are people that do. Okay, the slides for this are available. Kai has a copy in PDF format. If you guys want to reach out to me, it's easy. Mark@evotek.com, evotek.com. And if you don't remember Mark, you could just write to labs@evotek.com. Any questions, always open. If you guys see things a different way and think we're a little bit in the weeds or a little bit too focused on Silicon Valley or a little bit too focused on the enterprise side, not consumer, would love to have conversations with you about that. Terrific.
Okay. So the time is 6:57. I think we have to thank you. Thank Mark for such a great talk about VC. I learned quite a few new things. For this, I heard the second time, but I think a lot. Also, the conversation really great. So give him a hand, and we'll see you in some other time. So you can go ahead and do other things. All right. So for those, we're going to stay on the meeting.
Mark, safe travels, and if you see any coyotes, also look up for anvils.
You got it. You got it. All right, you guys take care. Be safe. Be healthy.
Yeah. So you can unmute.